Would you like to invest in a business that has their fingertips on the pulse of the entire global economy? Looking for a yield near 4% with double-digit dividend growth? Like the idea of getting a good deal on a high-quality stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global advertising and marketing giant that provides its services to more than 5,000 clients. A company's ability to control its message is more important and difficult than ever before. People can go online and say whatever they want about anything they want. Cutting through this with effective communication is very valuable, which plays right into the hands of this business. And that positions them for growing profits and dividends for years to come. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Omnicom Group Inc., which appear to be trading at a significant discount today. Omnicom Group Inc., stock ticker OMC, is an advertising, marketing, and corporate communications company with a corporate history dating back to the late 1800s. Omnicom is now a $16 billion by market cap marketing giant, employing over 64,000 people. Through over 1,500 subsidiaries and over 200 brands, Omnicom serves more than 5,000 clients across more than 100 countries. The company operates across the following fundamental business disciplines: advertising 59% of fiscal year 2020 revenue, CRM consumer experience 16%, public relations 10%, CRM execution and support 9%, and healthcare 9%. Their 100 largest clients account for approximately 54% of revenue. North America is their largest market, representing about 58% of revenue. Omnicom has exposure to almost every industry in every country. They practically have their fingertips on the pulse of the entire global economy. Investing in Omnicom Group stock is almost analogous to investing in the global economy all in one go. While investors might initially mistake Omnicom for a 20th century advertising company in a 21st century world, I see this as a comprehensive corporate communications company fit for the new environment. They help their clients shape the message that's communicated to customers. Omnicom does this in a very holistic way, managing that communication from top to bottom. Proper shaping, management, and distribution of a company's message is arguably more important than ever, as the rise of the internet has allowed for rapid and unfettered dissemination of information. The experience and breadth that Omnicom provides should therefore become even more critical and valuable. But one of the most compelling reasons to invest in the likes of Omnicom Group is the sticky client base. Once a company like Omnicom Group becomes attached to a client's marketing department, it's difficult to make a change due to switching costs. Furthermore, since Omnicom controls the likes of the acclaimed BBDO and DDB, the company can just move a client from one network to another. This would be far easier solution to accomplish for a client than switching providers wholesale. This should mean rising profits and dividends for many years to come. Omnicom has already increased its dividend for 12 consecutive years. Dividend growth took a short pause during the pandemic, but there was never a cut, and the company got back on track with a 7.7% dividend increase earlier this year. That's a bit off from their double-digit 10-year dividend growth rate of 13.2%, but I think they deserve the benefit of the doubt during an unprecedented period. In addition, high single-digit dividend growth is all you really need from this stock. It yields a market-beating 3.8%. That yield, by the way, is 50 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 45%, the dividend is safe. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single digit or better dividend growth rate. And this stock is, in some ways, on the very sweet side of that sweet spot. Looking at business growth, Omnicom's revenue is roughly flat over the last decade, moving from $13.873 billion in fiscal year 2011 to $13.171 billion in fiscal year 2020. Not great, but we have to consider that fiscal year 2020, with its pandemic-induced lockdowns and economic sputtering, was an anomaly. Backing things up just 1 year would reveal a much better picture for revenue. Meanwhile, earnings per share grew from $3.33 to $4.37 over this period, which is a compound annual growth rate of 3.07%. Significant buybacks helped to propel bottom line growth in the face of flat revenue growth. The outstanding share count is down by about 24% over the last 10 years. As with revenue, the long-term earnings per share growth picture would likewise look much better if we back things up only 1 year. The 9-year compound annual growth rate for earnings per share between fiscal years 2011 and 2019, for instance, is 7.77%. After studying the business and its various financial statements, I think that's a more accurate long-term growth profile for the business. Looking forward, CFRA is predicting that Omnicom will compound its earnings per share at an annual rate of 11% over the next 3 years. CFRA sees a, and I quote, high single-digit rebound in organic revenue in 2021, unquote, which should lead to a notable improvement across all the businesses under the Omnicom corporate umbrella. In my view, this is a reasonable expectation for the near term. To put things in perspective, Omnicom has reported $2.93 in earnings per share for the first 6 months of this fiscal year. That's a 171% year-over-year improvement over the first 6 months of last fiscal year. Like I noted earlier, I see Omnicom as a company that should be able to grow its earnings per share in a high single-digit range when I looked over a long period of time, smoothing results out for economic anomalies. However, because the next 3 years of growth is starting from such a depressed base after Omnicom's earnings got hurt by 2020, a short period of outsized 11% annual earnings per share growth is a justifiable assumption. I don't necessarily see Omnicom increasing its dividend at that same rate over the foreseeable future, as I think they'll want to moderate things and keep the payout ratio low. As such, I would surmise that Omnicom will produce high single-digit dividend growth for at least the next few years, loosely on par with what was delivered earlier this year. Moving over to the balance sheet, Omnicom has a rock-solid financial position. The long-term debt-to-equity ratio is 1.88. That might look high, but it's due to low common equity. Their interest coverage ratio of over 7 indicates no trouble with servicing debt, and that's on depressed EBIT. Moreover, the company carries enough total cash on the balance sheet to offset long-term debt completely. Profitability is robust and stable. Over the last 5 years, the firm has averaged annual net margin of 7.91% and annual return on equity of 47.39%. Despite the challenging year that was 2020, Omnicom is a high-quality company that is well on its way to a full recovery. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Competition in this particular industry is limited to only a few major players. It's an oligopoly. However, the limited competition that does exist is fierce. Any lasting scars from the recent pandemic-induced recession could have an impact on Omnicom's future earnings. The digital marketing landscape continues to quickly evolve. Any missteps by the company's various agencies in this regard would likely have consequences. Lastly, I see some existential business model risk if marketing moves in-house on a wide scale. This would greatly affect Omnicom. With these risks known, I still believe this company can make for a great long-term investment. That's especially true right now with the stock's valuation looking rather appealing. The stock trades hands for a price-to-earnings ratio of 12. That's significantly lower than the broader market's earnings multiple. It's also notably lower than the stock's own 5-year average price-to-earnings ratio of 14.6. We can also see a disconnect in the cash flow multiple. The current price-to-cash flow ratio of 7.1 is well off of its own 5-year average of 9.4, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. That's rather conservative when you look at their demonstrated long-term dividend growth rate, and their most recent dividend raise, which came during a recovery from a global pandemic, was nearly 8%. There's also the fact that CFRA is expecting 11% near-term earnings per share growth. To top it all off, the payout ratio is moderate. However, I'd rather err on the side of caution with this particular business model, as I think there are valid long-term existential questions as society and business continues the slide into digitization. The dividend discount model analysis gives me a fair value of $85.20. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as $8 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Omnicom as a 4-star stock with a fair value estimate of $89. CFRA rates Omnicom as a 3-star hold with a 12-month target price of $82. I came out right in the middle this time. Averaging the three numbers out gives us a final valuation of $85.40, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. Omnicom Group Inc. is a marketing powerhouse with great fundamentals and broad exposure to almost every industry and country in the world. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, 12 consecutive years of dividend increases, and the potential that shares are 14% undervalued, this high-quality dividend growth stock offers a compelling long-term investment case for dividend growth investors. And now for a special news announcement. Lowe's Companies Inc., stock ticker LOW, just announced a fantastic second quarter that saw them beat earnings expectations by a full 30 cents per share after coming in at $4.25 in earnings per share for the quarter. That's good for 13.6% year-over-year earnings per share growth, even after tough comps from the blockbuster year for the business that was 2020. I recently highlighted Lowe's as an undervalued dividend aristocrat to consider. This quarterly report proves how amazing this business truly is. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.